In 2026, the deepest assumption in markets is the backstop, that at the first sign of real trouble, the Federal Reserve will cut, lend, and print to prevent collapse. There was an era when the central bank did the exact opposite, on purpose, for years. This is the archive of 1929 to 1933. This is an archive of the 1929 crash and the monetary contraction that followed, documented economic history only, not a forecast, not investment advice. Chapter 1. The Boom. The 1920s were a genuine technological boom. Electrification, the automobile, radio, mass production. The stock market rose for most of the decade, and from 1928 the rise became near vertical, fueled by buying shares on margin with as little as 10% down. Credit, leverage, and a belief in a permanently high plateau of prices combined. The same ingredients that appear before every major top in this archive were all present. Chapter 2, October 1929. After peaking in early September, the market broke in late October. The 24th, Black Thursday, and the 29th, Black Tuesday, saw waves of forced selling as margin loans were called and collateral evaporated. 89%, Dow peak to trough, 1929 to 1932. The crash itself was severe but survivable. What turned a market crash into the Great Depression was what happened next, and the response, not the crash, is the real subject of this archive. Chapter 3. The Policy Failure. Between 1930 and 1933, waves of banking panics swept the United States. As banks failed, deposits vanished and the money supply contracted. The Federal Reserve, created in 1913 precisely to be a lender of last resort, largely stood aside. Constrained by the gold standard and a prevailing view that weak banks should be allowed to fail to purge excess, the Fed let roughly a third of all American banks collapse and the money supply fall by about a third, one-third. U.S. money supply collapse, 1929 to 1933. Chapter 4. The Depth. The contraction of money and credit fed directly into the real economy. Unemployment reached around 25%. Industrial production roughly halved. Prices fell year after year, a deflationary spiral that made every fixed debt heavier. The Dow did not regain its 1929 peak until 1954. 25 years later. The cost of the policy failure was measured in a generation. Chapter 5. The Reversal. Recovery began when the policy reversed, leaving the gold standard in 1933 freed monetary policy. Deposit insurance stopped the bank runs. The lesson drawn, that the central bank must flood the system with liquidity in a panic, became the founding doctrine of modern crisis response. The 2008 response, and every backstop since, are, explicitly, the anti-1931. Policymakers built the modern backstop precisely so this archive would not repeat. Chapter 6. The pattern the record shows. 1. Tech boom plus extreme leverage drives a vertical market. 2. The crash itself is severe but survivable. 3. Policy failure, not the crash, converts it to depression. 4. Recovery comes only when the backstop finally arrives. This archive does not predict whether the modern backstop will always arrive or always work. It documents the one era when it did not come and what its absence cost. The archive stays open. This is what the historical record shows.